In this week's video, we'll review the latest charts to help us answer the question, did this week's sharp reversal in stocks mark the final low? The summary slide in last week's video contained these two words, max nimbleness. Given the S&P 500 staged a sharp reversal during Thursday's session, this week the Dow finished 1,786 points off of the intraday low Thursday. The Nasdaq finished 1,107 points off of Thursday's intraday low, and the S&P 500 finished 270 points above the low that was made on Thursday after it was announced that Russia invaded Ukraine. Here's the chart of the S&P 500 as of the close on February 25th. Still somewhat of a mixed bag in the short to intermediate term. There's some good things here. We recaptured some levels that were important. This closing low, the October closing low. If you thought this was the neckline here, it's only a neckline if this turns out to be a head and shoulders topping pattern. But all of this represents areas of possible support and also represented areas where stop loss orders were set, as we discussed last week. This is still a battleground, and from a short to intermediate term perspective, the S&P 500 has work to do here. But what we've seen so far is encouraging. At the end of the week, we had this hammer-type look from a psychological perspective. On the weekly chart of the S&P 500, this indicates the sharp reversal here and the close near the session high for the week. While there are always an infinite number of factors and moving parts relative to markets, this topic here was probably relevant in terms of psychology flipping on Thursday. S&P 500 finished the week up about 36 points, and maybe more importantly, RSI held some of these key levels where the S&P has made a stand in the past. It's a daily chart of the NYSE composite as of the close on Friday, February 25th. This is your failed bearish breakdown look here and then the sharp reversal. This is a daily chart here. This is Thursday's session. This is Friday's session. The NYSE closed near the session high. Like the chart of the S&P 500, this still has work to do from an intermediate term to short-term trend perspective. And the NYSE composite also finished the week up 35 points. Nothing really definitive yet relative to interest rates calming down. In fact, they're hovering around the highest level that we've seen since the COVID low. And if this trend continues, and that's to be determined, it would increase the probabilities that value will finally break out relative to growth. It still hasn't happened here. This week we had, this looks like a false bullish breakout at the moment. So for the time being, still remain in this range. The recent breakout in energy tells us to keep an open mind about value winning this battle, but it has to do it, and it hasn't done it clearly yet. No real winners and losers on this front this week. Value relative to the S&P 500 for the full week was basically flat, even. Value underperformed slightly, and value relative to growth, same story, relatively even. VTV underperformed VUG for the full week by just 0.12%. Still inside of this range on the weekly chart as well. The long-term trend is down, still in favor of growth, but this is a W formation here, and if we get a bullish breakout, have to keep an open mind about this trend flipping. Equal weight S&P 500 relative to defensive treasuries. There's the economic COVID fear look over here. You can see the look in the present day is significantly different, and for the most part, we've been hanging above the 200-day moving average in red. We talk about this chart later in the video. This is what it looked like as of the close on Friday. If you want to double back, we showed this chart 1 or 2 weeks ago. For now, this area of potential support. The market's trying to bounce here, SPY relative to gold. Like the chart of the S&P 500, they're still duking it out here, and we'll see what happens. For the full week, SPY beat GLD by 1.14%. We'll cover the VIX in more detail later in the video. It might be helpful to know that it finished down 9% on Friday. You can pause your video player. Something that just happened tends to be bullish, looking out 1, 3, 6, and 12 months for the stock market. This is one of many positive developments, anecdotal positive developments that we'll cover in this week's video. This is small caps. You can see well below this gap here during the session on Thursday. This is as of Thursday's close, and the sharp reversal and back above the gap. Also noteworthy, all of this is taking place near the 50% retracement of this A to B move. Cover some similar stats in the video. This is a different way to slice and dice it, going back to 1965. This is another way to look at sentiment. Here's the source of the chart. It's telling us when you get up here relative to recent history, something like this has tended to occur near lows in the S&P 500. Given the still mixed look of the chart of the S&P 500 that we covered in the opening segment, these concepts, this quote, and this data set, all of it still applies. Now let's shift gears and cover a handful of anecdotal cases relative to observable and bullish shifts that took place during Thursday's session. Before we talk a little bit more about the big story of this week, Russia invading Ukraine, try to get some idea where we stand relative to the 4 to 15% hypothetical drawdowns that we've been covering for some time. This chart of the S&P 500 was covered on Friday, January 14th. And before we see where we are after the big reversal on Thursday, let's review some slides that we've covered in the past, and you can pause your video player if you want to look at a little bit more detail. The number to remember here is 9%. Since 1980, the average pullback of more than 5% that wasn't tied to a recession was basically 9% in the S&P 500. This data set looks at all S&P 500 drawdowns greater than 5% going back to 1990. The average drawdown in the S&P 500 using this data set, a little bit under 12%, 11.83%. The market typically bottoms in 56 trading days. So our two numbers to remember are 9% and 11.83. As you can see, you can slice and dice this many ways. Another way to look at it is the average maximum intra-year drawdown going back to 1980. That comes to about 14.3%. If we put those three figures on our hypothetical drawdown chart, we give us some idea of where we stand. Here's 9% here, the orange line. 11.83 would be in this area here, and 14.3 would be just a little bit above the 15% level here and a little bit below the 14% level here. So how did this chart look as of the close of trading after the big intraday reversal that occurred on Thursday, February 24th? Here's the answer. This was the intraday low here. This is the close here. And if we put a box around these levels here, something stands out. Number one, it's twice now that we've tried to make a stand inside of this box. And history tells us that typically a correction's going to make a stand somewhere in this general area. And of course, we're talking about average and median outcomes. But from a risk-reward perspective, even if this isn't the lowest low that's going to be made, and we don't know that in any shape, form, or fashion, there's no question that some of the hard data improved relative to where we were intraday down here and where we were at the close. Nothing earth-shattering, but in the context of this week's invasion, it's also helpful to know that in the past, when the news really hit peak fear, the invasion, typically the S&P 500 tended to rally after the invasion. And from a common sense perspective, that can make some sense. Wednesday night might have been maximum fear, and during the opening hour or two of trading on Thursday, we were also somewhat in hypothetically or potentially maximum fear. And in the past, buying maximum fear, at least in the short to intermediate term, has worked out pretty well. Not a prediction about what's going to happen walking forward in the present day. It simply speaks to probabilities. Did anything else occur during Thursday's session that might be helpful in terms of assessing intermediate to short-term odds? You can pause your video player here or find this in our Twitter feed here. Here's the handle. Daily RSI did have a positive divergence. You can see price makes a lower low. RSI makes a discernible higher low here, somewhat similar to the bottoming process at the COVID low here. And numerous charts, and many of them we'll cover in the slides that follow, had what appear to be now failed bearish breakdowns and then reversals. And we all know that a failed bullish breakout can be bearish, and conversely, a failed bearish breakdown can be bullish. So we've got a history, we've got a divergence, we've got some failed bearish breakdowns, at least in the short run. Whether or not that remains, we don't know that. Anything else? Yes, sentiment has been lopsided. Tweet here, here's the handle. The average bull-bear spread matching the same levels we saw at the COVID low. So sentiment similar here to here. RSI similar. And this blurb here comes from the Wall Street Journal. Call options on single stocks as a percentage of total options activity recently fell to the lowest level since April of 2020. Where's April of 2020? Right here. None of it predicts anything. All of it speaks to improving odds. Latest AAII sentiment survey. Highest level of pessimism since April of 2013. As you can see here, April 1st, 2013, from the close on April 1st to this peak here in May of 2015, pessimism was lopsided in a manner similar to what we have today. The S&P 500 gained 36.4% from point A to point B. When the S&P 500 made the low in January of this year, you can see the VIX spiked during the day and then closed well off the session high here. Something similar during Thursday's session. A big spike up. Also noteworthy that this high here, even though price is lower, price is down here, the VIX makes a lower intraday high relative to this high, and also comes off of that level into the close. Doesn't predict anything. All things being equal, prefer to see a look like this relative to reversal probabilities. Doesn't guarantee anything. Similar situation with ARK. The VIX closed 21.12% off of this session high on Thursday. ARKK closed 13.95% above the session low, so it had a sharp intraday reversal on Thursday. Clients and regular viewers know that we've covered numerous studies over the past year that said from a probability perspective, the maximum one-year drawdowns told us this June 2021 low here where my cursor is might be somewhat of a probabilistic reference point. We covered this chart in January of this year and originally covered it in September of 2021 based on this study here. If we fast forward to the close on Thursday, you can see intraday the market came down right in the vicinity of that June low, actually overshot it intraday, and then closed back above it. Nothing magical about this level here. It's simply a reference point that came up numerous times over the past 12 months. And like anything else, it can just help us assess probabilities. All things being equal, if you're a bull, you'd really prefer to see price stay above this level. If you're a bear, you obviously want to get into this area here. Update on the software index, this A to B move here. Still trying to make a stand at the 50% retracement as of Thursday's close, up 2.02% for the week and back above the 50% retracement here. Made a stand here at the 200-week. S&P makes a stand at the 200-week near the COVID low. S&P makes a stand. We're in a similar area here, and as we mentioned previously, Hard to make the argument that this looks as good as this or this, but we're still trying to make a stand there. This falls in the to be determined category. Going back to this topic here, if you looked at numerous charts intraday on Thursday, February 24th, including the chart of the Dow Jones Composite Index, if you looked at a high-low close version of this chart, it really didn't look good. Price got down into this area during Thursday's session, and it looked like a significant breakdown from a multiple month period of consolidation. And then by the time we got to the close, we had moved back into the range and finished up 0.79%. It's possible that that represents a failed bearish breakdown, and it's also possible that we saw numerous examples of stop-loss orders executing in here, and then once they executed, the market rallied. Market took a baby step in the right direction. The odds have improved a little bit. If we were 100% sure that we had an all-clear signal, we would be 100% invested. That is not the case. Cash that we still have speaks to the fact that the market still has some work to do. As we've mentioned several times in the past, technical analysis is really about discerning what can be sometimes subtle differences. If you look at the volume-weighted average price for the S&P 500 going back 10 trading days, you can see price had a difficult time getting above the line in blue. And when we got above it here, sellers stepped in. Probably fair to say the session on Thursday was quite a bit different. We spent almost the entire session above the volume-weighted average price shown in blue. Subtle, but possibly significant. There's a spike in fear here in early December of last year, a lower spike in fear when the S&P 500 made the low on January 24th. And today, when price was lower, a significant lower low, especially intraday, you can see we spiked even lower. This is a 15-minute chart as well, so it shows us what happened during the session, and this is what you would want to see if things are going to improve. From a longer-term perspective, this is your increasing economic fear look here during the COVID plunge in the S&P 500. You can see the ratio really hasn't gotten a lot of traction relative to this look over here. This is TLT divided by SPY as of the close on Thursday, February 24th. I covered this chart last week. It really doesn't look as bad as you might expect. This is XLK, the tech sector, S&P 500 tech sector, divided by the S&P 500, or VU. It's a weekly chart. The last thing it did was have a bullish breakout, and it's still staying above an upward sloping 50-week moving average. And even on a daily chart, last thing we did, new all-time high here. We came back here and held twice at the 50% retracement of this A to B move. Again, intraday, you're down here, you get a reversal, you close above an upward sloping 200-day. Does this chart look great? Still looks indecisive, but relative to other charts like this, so other ETFs divided by SPY, this is a pretty good look, especially when you look at it going all the way back to 2020. Here's another failed bearish breakdown look intraday. We broke down below this upward sloping green trend line here and then finished near the session high. This is about 8 minutes before the close. SP high beta was up 3.5%. All of these charts have to be taken in this context. Typically, when the market reacts favorably to bad news, we should pay attention. So this is defensive XLP divided by SPY. This is the close on Wednesday. So on Wednesday evening after the close, Russia invades Ukraine. You would expect this ratio to move in this direction really all day on Thursday based on the news and based on the futures. Dow futures overnight were down somewhere in the order of magnitude of 800 points. Instead, defensive staples gapped down at the open relative to SPY, and you can see the gap still remained. Could show a lot of charts with a similar theme. GLD gets a breakout intraday above this level here. It's been consolidating in this range for a long time. You can see the intraday high is way up here, and then we get somewhat of a failed bullish breakout look at the close, closing here around 177. Diversified, read higher risk bonds relative to lower risk treasuries. Here's your increasing fear look in the credit markets during the COVID plunge in the S&P 500. This is the look relatively late in the session on Thursday. Instead of breaking down, we're still consolidating. You can pause your video player here. From a short-term perspective, some relatively minor but noticeable developments. S&P 500 15-minute. You can see we get the big gap down. Not unusual to come back into the gap during the trading day. It's a sign of strength when you can exceed the gap as we did here on the 15-minute chart and then stay above it for the entire session. You can see 15-minute RSI as well got into an area that it's had trouble getting into recently. And 30-minute RSI, you can see, broke above this downward sloping trend line. Whether that's a sustained breakout or a head fake, that remains to be seen. This is as of Thursday's close. You can also see on the 30-minute chart, prices here. It's lower during Thursday's session in the morning. And you can see RSI here quite a bit higher here relative to where it was on January 24th. You know, all of this is great, but the Fed's getting ready to raise interest rates in March. That's true, and we have to remember markets are forward-looking mechanisms, so the 10-year yield is really already moved in some ways, anticipating those Fed rate hikes. We've covered this in the past from LPL Research. After the first Fed rate hike, till the next bull market peak, on average, the S&P 500 gained 67%. The median gain was 50%. And after the first Fed rate hike, the market typically rallied on average for 3.4 years. S&P 500 has been trading in this 10% to 15% correction window. Typically, 1 year later after a bottom is found, stocks are typically about 22% higher. And from a risk-reward perspective, if this is a correction, and we don't know that, that's hypothetical, then in terms of history, we've really probably experienced most of the pain. And typically the market's higher for this type of correction, about 22% higher a year later. So from a risk-reward perspective, when we're down here in this area on Thursday, I have no idea whether this is the low or we're going lower. But on a longer-term time horizon, to redeploy some of our capital in this window, from a probability perspective, it starts to make sense, especially when we see some evidence of improving risk appetite. So as we've mentioned numerous times in recent weeks, we have to think about risk, still have some cash around, and we also have to think about reward, the other side of this. There's some information that we covered in the January 21st video. Here's the source of that information. Here's the Twitter handle. Talking about NASDAQ drawdowns. Average drawdown after the financial crisis low in 2009, 15.2%. All since 1970, about 19.5%. The median since 2009, about 12%. And the median going back to 1970, about 16.6%. So where do we stand after the close on Thursday relative to these historical drawdowns? Here's the peak in the NASDAQ, the closing peak on November 19, 2021. If we experienced a 15.2% drawdown, we would drop to 13,616, which is this level here. So all four of these hypothetical declines are shown via the horizontal lines. If we fast forward to the close on Thursday, where do we stand relative to these average and median drawdowns? You can see on Thursday morning we overshot, and then we came back, just like the S&P 500, somewhat right into the meat of the average and median or typical drawdown based on history. from a risk-reward perspective, especially if we're thinking 12 to 24 months out, this typically tends to be an attractive band in here. And we might think the NASDAQ is dead because the Fed's going to raise rates. That may or may not be true, but we covered this in the past. In this cycle here that started in 1994, this one in 1999, 2004, and 2015, number one performing sector while the Fed was raising rates was tech. That doesn't mean that's what's going to happen in the future. It's just telling us, taken in isolation, the Fed and rate hikes doesn't necessarily mean the NASDAQ and or tech is doomed. As far as the S&P 500 goes, intraday we dropped all the way below the 14% line here and then closed between a drawdown of 10% and 11%, which basically says we're down about 11% year to date. And as the data shows here, unless we're in a recession or in a world war, and the odds say the market's probably going to go up between now and year end. How it gets there, if it does, the path, that's to be determined. Also noteworthy, we covered this in the past. From a valuation perspective, the NASDAQ and tech have both come back down to earth. So a lot of the figures that we're covering and figures that we've covered in the past say typically things are a lot better when you can avoid a recession. We have the recent example with credit spreads. Here's your recession, the shaded area, and you can see this huge spike here. Here's credit spreads as of February 23rd. We still really haven't moved a whole lot in recent sessions, which basically means fear about defaults, and maybe more importantly, fear about counterparty risk and or fear about the credit markets operating properly is still quite a bit lower in the present day than it was here, the COVID peak. Quite a bit lower in the present day than it was in Q4 of 2018. Quite a bit lower than it was in Q1 of 2016, and not even in the same league relative to what we saw in this recessionary period here during the financial crisis. And going back to 1980, pullbacks that were more than 5%, those that weren't tied to a recession, the typical decline was about 9%. Even in this table here, some of your biggest drawdowns come 1990 near a recession, 2000 near a recession, 2007 near a recession, COVID near a recession. Credit markets not really screaming recession at this point. The labor market remains strong, including the data that we received this week. And recent data relative to industrial production, present day is really the polar opposite over here relative to this, and this. All three of these periods, 90, 2000, 2007, all were associated with recessions, the same periods that have some of the worst drawdowns on this table. Covered this in a recent video. Bank of America Merrill Lynch. U.S. consumers are sitting with a record $19 trillion in cash, a 35% increase from 2019. The unsustainable leverage that we saw during the financial crisis is non-existent today. Banks better capitalized than ever. Wall Street Journal, January 27th, household balance sheets look to be the healthiest basically since we've been tracking data going back to the 1980s. Also speaks to the odds of a recession. Latest reading that we have in the Chicago Fed National Financial Conditions Index. Is it tough to get credit like it was in the 70s when we had a recession up here? No. Tough to get credit during this period here like the financial crisis? No. In fact, credit conditions are still in the most favorable in history territory here. How about during Thursday's session? High-yield bonds relative to treasuries, HYG divided by IEF. This is the look of the chart. We covered this one last week. This is dated February 18th. You can see this upward sloping trend line here. What happened during the big reversal on Thursday? We came right down to that trend line, tagged it and bounced, and close near the session high here. Doesn't predict anything. It's just the close on Thursday looks a lot better than having a close down in this area here. Stocks versus bonds dated February 17th. As the same chart looked today. Haven't lost the breakout up here as of February 24th. You can see here, this is what a recession and large drawdown period in the S&P 500 looks like, these two orange lines relative to the ratio. This is what's still happening in the rearview mirror in 2022. Remember, we covered this last week. Sentiment trader, individual investors don't get much more bearish than this. Average gain a year later, 19.65%. Median gain a year later, 20.37%. 94% of the cases, the market was higher. That's a signal that we received recently, something that happened in 2022 that speaks to the probabilities, the risk-reward ratio in this box here, looking out 12 months. Doesn't guarantee anything. Covered this last week. Non-recessionary cases, the NASDAQ was higher by almost 28%. 12 months later, the median gain in the non-recessionary cases, 24%. A signal that just happened recently, something that happened in February 22 that also speaks to the risk-reward ratio when we're in this typical drawdown band and we're thinking about where the NASDAQ may be in 12 months, not the next 3 or 4 sessions. Also good to keep in mind, in years where the Fed raised rates 4 or 5 times, average and median gain for the full year is positive. So if you're down roughly 10 or 11% now to get to this level or this level, you have to rally between now and year end. And if you look at this chart, it's even better if you pull out the cases that are associated with recessions. Recently from the Wall Street Journal, also about lopsided sentiment. 3 out of the 5 most active days for put options trading in history have occurred in the first 3 weeks of 2022. According to the CBOE. To summarize, after the close on Friday, sentiment, S&P 500 and most major markets, risk on, for the most part, flipped into full-bore mode around 1:45 p.m. on Thursday. The market reversed early in the session, but this is when it started to really take off. We do have numerous signs of a higher tolerance for risk. However, the short to intermediate term trend for now remains down until proven otherwise. This is taken into account in our current allocations, and this is taken into account in our current allocations. Inflation rates and the Fed still ongoing issues, and we all know when these issues are factors, then it wouldn't be shocking if volatility continued for some time. For our time frame and for our approach, yours may vary significantly. The question of whether the final low has been made or not is not really the relevant topic. The more relevant topic is what we've covered this week for us. What does the longer-term risk-reward profile look like? How did it look during Thursday's session? And what does it say about the probabilities looking out 12 to 24 months? Still have to keep an open mind about ranges, retests, and whipsaws. Till proven otherwise, that's part of this calendar year. And it may be the case that 2022 ends up being one of those years where the Fed is altering interest rates. There's a possibility that we end up with somewhat of a tepid return, maybe high single digits. That would be the bad news potentially. The good news would be we could also be setting up and digesting gains for an excellent 2023. Of course, all of that is to be determined and does not represent a forecast in any shape, form, or fashion. These 4 bullet points here, incredibly helpful this week. And we all know the only way any of this works is if we had it next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.